Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project Podcast. I'm your host, Steve Fierros with Tri-City Equity Group. With me is my co-host, Vince Gethings. Today, we have Andrew Lanoie on the show. As co-founder of Four Peaks Capital Partners, Andrew oversees the company's investor relations and asset management. Previously, Andrew was a talent agent at William Morris for 16 years, representing the likes of Taylor Swift. Shout out to Swifties out there, and you can tell I have
that's me.
Steve Martin, which is pretty awesome, and Tom Petty, which that's a whole nother audience right there. In 2009, Andrew started an initiative to acquire single-family investments and quickly realized the demand for affordable housing in the United States. Since starting Four Peaks, he and his team have become a top 100 owner-operator of manufactured housing, that's impressive. And with over a decade of experience, Andrew understands the challenges investors face and is passionate about helping them overcome those obstacles and achieve financial freedom. Andrew, welcome to the show.
Hey guys, thanks for having me on. Really appreciate it.
Yeah, we're excited to have you on. So those of our listeners that maybe aren't familiar with you, tell us a little bit about yourself and how you got started in your real estate investing journey.
Yeah, so I was in corporate America. I lived in Los Angeles for about 20 years and worked at, if anyone's seen the show Entourage, I basically worked for that company. We actually created that show, which was Mark Wahlberg's kind of rise to fame and all the things that went along with that. So represented a bunch of comedians and touring artists and did that for a long time. And when the subprime crash happened, my folks lost a lot of money in that downturn. A lot of their retirement portfolio got a pretty big hit, and my money was all tied up in a 401k, and I was just blindly putting in and had a financial advisor like a lot of people, the route people go down, and realized I needed to diversify. And so that's kind of started the whole journey in 2008, and read a million books and Rich Dad and a number of other books, and kind of went down the rabbit hole and realized I needed to have my portfolio in real estate. So I started investing in single family houses in Dallas, Texas, probably about 2009, which, just hindsight being 2020, was a great time to get into that market. And once you kind of figured that out and the prices were right and things were cash flowing, then was pretty aggressive and bought a lot of single families that were in Dallas, Memphis, and Atlanta, probably about 2009 to 2012, 13. And that was kind of the foray into it, and really stopped buying after things started. The single family market felt like it was getting pretty frothy back in 12 and 13 and 14, at least as far as a cash flow model. So stopped buying around that time, but that's how I got into real estate. What
a jump. I mean, that's an industry, that's an incredible industry to be in, right? You're working with these kind of very high profile people, and I was a fan of Entourage, so kudos to you for working on that show. But yeah, what a jump, to real estate side, and that's obviously taken off for you. What do you guys kind of tell me, what you guys are kind of working on at the moment? Now, you've obviously come a long way. You went from the single families, you stopped investing, but obviously you didn't stop investing totally in real estate, I'm sure, at that point. What was there a transition? What was kind of the next step after your single family journey?
Yeah, so probably about 2013, I think that's when deals were hard to pencil out at that point. So looked around at apartment buildings, looked around at commercial, just a lot of other asset classes. And I had a friend who was buying mobile home parks in the Midwest, and that took a really good look at that model in manufactured housing. Already knew from the rentals that I owned that there was a huge demand for affordable housing in the US. And after kind of looking at everything, including multifamily, it seemed like there was just a massive opportunity for the manufactured housing space. So started to get into that probably about 2014, and started to buy mobile home parks and put the companies together at that point: construction company and property management company, the equity company, and started the journey probably about 2014. So I guess we've been doing it maybe about six and a half years now, something like that.
That's awesome. So you guys went totally vertical on that one then. I mean, that's a pretty short period of time, and to control all the different facets of everything what's going on and for the investments.
Yeah, definitely was. My partner's been in the space. He and his wife started buying mobile home parks back in 2007. So they've been in the space for about 13 years. It's been really interesting to see over even the past year, our space has become so popular. And a lot of that is inventory in general out there is low. Investors are looking for yield. Interest rates are at an all-time low. So there's all these really interesting things happening at once. That's all really hard to find yield. And so there are more and more people getting into our space. Blackstone just made a $550 million investment several months ago. That was a big deal. I think that was the first time. A lot of institutional companies in the space. And so, through COVID and everything, here we are in almost the middle of December, and we wake up every day and we're just grateful that we own affordable housing, and we don't own office buildings, and we don't own retail, and we don't own restaurants and these other asset classes that are just getting decimated right now. So it's been a pretty wild year and a really hard year for a lot of people. But, we've always been kind of stuck to our affordable housing guns. And it's been good because of that this year, at least.
Yeah, no, for sure. Just to kind of backtrack a little bit, was this something that you obviously had switched gears at one point. Did you have any type of background? Your family have any kind of background, in real estate, or, I'm just trying to think of, the kind of the mindset of having a comfort level. Obviously, you guys are operating at a much larger scale. You picked up some mentors and some partners kind of along the way. But did you have a background in real estate at all?
No background at all. And my dad had kind of tinkered around with it when he was younger, and I think he had a fourplex or something, and tried to manage it for a while, and it just wasn't for him. But really it was what happened in the market and the subprime crash that triggered all of this. And I realized, hey, my parents we grew up in lower middle class in New Hampshire, and everything was great and had a normal upbringing, but they did everything right? They went with the financial advisor model. It was save, and put your money in the market, and everything's going to be okay. And they got hit really hard. And at that time, I realized I needed to have my money out of the stock market, because it's just, no one's getting rich in the stock market in general. I mean, it's just volatile. And it's just a really stressful place to keep your money. So that was kind of the trigger point. But honestly, it was personal development. It was getting into, probably read 100 books in 2008 and 2009. And before that had not even scratched the surface of that many books. So read all the, books on economics, and kind of led into real estate investing. Ken McElroy's a close friend of mine for about 12 years now, and read his books, the ABCs of, he's got 2 or 3 or 4 books on real estate investing and property management. And so all of that stuff, right. And the Rich Dad. And I think, it's great to have mentors, and especially if you're scaling and you're going that angle, but really anyone can get on the internet now with YouTube and find absolutely incredible free resources to at least get them on a path if they're trying to figure out what to do next. So, education for me and for, most of the folks that we hang out with, it's pretty paramount. You're just reading books and audiobooks and podcasts, and you're just consuming information to get ideas and figure out what to invest in.
Yeah, I was actually gonna say, and Vincent, I'll pop it over to you here in just a sec. But that actually, your experience, let's say with production and all that kind of stuff, I've got to think that you actually you had to have made some pretty good connections in there. Are those people, did you find that they were investment savvy at all, or have those been connections that you've maintained kind of over the years? And hey, you know what, we can offer some different types of investments maybe you're not traditionally thinking of, that kind of deal.
Yeah, here and there, and a lot of that world with kind of high earning individuals, like they're going the financial advisor route, right? They've got their money in the market. That's the norm. So absolutely, was there a handful that kind of, we were making investments together, buying houses together and everything, like absolutely. But it was a very small percentage of, out of 1,000 people, maybe it was 5, right? Because the norm is, well, you get a financial advisor and you trust that advisor to steer your money in the market. And that's your diversification is all within the stock market. And unfortunately, that's what our society's been told and trained, right?
They're not telling you to buy real estate. That's for sure.
Yeah.
They're not getting paid. They're not getting paid on that. So
yeah, that's right. That's right.
All right. Well, you queued up a bunch of questions for me, so I'm going to just kind of attack all the notes I just took. So real quick, you started off on the single family route, bunch of those. Do you still have those in your portfolio, or did you exit those and use that capital to start your path to the 2,500 mobile homes?
Yeah, a lot of that, what they were sold off. And what happened, which was interesting, is Dallas, for example, if I was buying houses in 2009, let's say they were 125,000 and four bedroom, 3 bath, couple thousand square feet, like nice lot near a good school, renting for $1,500 or $1,600. Dallas kind of got blown out of the water from 2009 to 15, 16, even through today. I mean, it's been such a hot market. So those houses, a lot of them doubled in about 5 years. And the challenge with that is, well, you're paying a lot more in property taxes because the property taxes, they reassess every year. Your rents certainly aren't pegged with your equity as equity rises in a situation like that. And at some point, it didn't make sense to sell them to investors anymore. Like if I was trying to exit some of those properties, which I did, they were really all done one at a time individually, because someone's lease would be up and then we'd go market that property at market value to an owner occupied, right? Someone looking to buy that house, which made a lot of sense, because someone's going to say as an investor, well, hey, that's a $225,000 house that's renting for $1,700. That doesn't make any sense, right? I can barely cash flow that with financing. But for an owner occupied, that was market value. So it did make sense. So yeah, so long answer to your question is, I did liquidate everything. It took years to do. If I had done it later, I probably left some on the table, but it's fine. Sometimes you don't have to time the market perfectly. I mean, I got in really at the bottom and had a really great run and good cash flow, and then exited. And a lot of those proceeds went into the company and the property. So it was all worthwhile. And if I had held it, another 5 years, like, sure, there would have been some more proceeds there, but it was definitely a good exit.
And went the exact opposite way. So it's always hard to, assess that. You're at that moment, you're like, okay, what's the opportunity cost? What's the the value of this, the net present value of this cash now? And so, okay,
absolutely.
So I had the same thing. I had 20, my original portfolio was 20 units. And earlier this year, I made the decision. I was like, I'm going to sell it. The market might keep going up, but I'm going to sell it and redirect that cash into multifamily. And some of them I sold at left some meat on the bone, as you said, but other ones, I sold it to somebody that was going to go get a conventional, 30-year loan. I had a single family, right? A couple single families, and they were like, this is par for the market. So I had no problem selling those at market rate. But yeah, right on path of what your process was there, of just, for me, it was like the cash value now is worth more than maybe trying to squeeze out another in the future. But at the same time, it could have went the other direction. I could have lost all that equity. So you're big on recession-proof investment. So what does that vehicle look like for you? Because, as we talked about before the show started, depending on what generation you're talking to, that could be completely different. I talked to my parents, I talked to recession-proof investments. They're talking precious metals. Like, I got some gold coins, I got some silver, things like that. I talked to my grandparents, and they're going to say like bonds, like that's their recession-proof investment, is just go buy US bonds, that they're good. Put them in a safe deposit box and don't look at them for 20 years. Kind of thing, and just get the coupon. So what does that look like for you? And then I'll steer it again to what the American dream is looking like going forward. So
yeah, I think for us, I've always been a cash flow guy, right? So it was never I've never really been a house flipper, although I did some flips in Atlanta as part of houses that we were buying. But I've been more of a long-term buy and hold cash flow guy. So California is a great example. You could buy a house in Los Angeles County and not make it cash flow. Maybe if you bought it in cash, it would cash flow, of course. But 20 years later, that house could be worth 3 times the amount that you paid for it. It's a very expensive state. Same thing with other states and markets around the country. So I kind of went down the path of, well, I'd rather go into a market like a Dallas or Atlanta or a Memphis, or wherever. We're in 12 or 13 states now in secondary markets, which has all been good. But I'd rather go in somewhere else and not necessarily have to depend on the equity as being a huge part of that investment, and really just being the cash flow of those investments. So I think in general, when I think of recession proof, I know that our asset class manufactured housing and mobile home parks through the subprime crash did really well. We have data on that. I've talked to operators, including my partner who went through the subprime owning mobile home parks. One of the first questions I asked him was, well, how did your properties do? And he said, well, a couple did the same and a couple actually did better. And what we found with our portfolio through COVID, which is certainly not a recession, it's this, I don't know what the heck it is, a pandemic, a global meltdown, whatever it is, but our collections have been at 95% through this, about 1 or 2% down from same time last year. So, we have other parts of our business that were impacted. Commercial lending completely froze back in March and April. All the private equity really stopped for a while, and everyone kind of pumped the brakes because no one had a playbook on this year, 2020. But, again, we wake up every day and we're thankful that we're in affordable housing because that as a sector, I think has done really, really well. And I don't think I would just personally compare cash flowing real estate to like bonds or, precious metals. They're just different, right? I mean, I own a little bit of gold and silver, but it's a very small part of my personal portfolio. I mean, for me personally, it's all about real estate. And what we do now on my side, of course, it isn't passive because we're the operator and the sponsor, but our investors are passive in these deals, which is how that's structured. But yeah, I think recession resistant, just what survived some of the big, imagine if your whole portfolio right now was office spaces. I mean, you'd be, your portfolio would be decimated, or if you were a restaurateur right now, or a lot of retail. So I think affordable housing's been pretty spot on through some really hard times.
We agree. And you said the key word there a couple of times is cash flow. That's one thing you want to make sure is that you're not banking on, appreciation for your yield. Cash flow should make up a significant portion of your returns. As we now and then as you look forward for future investments, I think will be key for people looking, making sure your deal's cash flow. Yep. So another one of your topics is, talking about the American dream is dead. I completely agree with that. And I had this conversation with many, many people, and finding people are unwilling to accept that. Do you think it's like a lack of education or just straight up fear? Like they're just afraid of not being able to work 20 years, get a pension and whatever. And it's like the data is out there. Like you're seeing, people having to work well into their 70s and 80s. Yeah, it's right there in front of us. Why do you think people are not willing to accept that version of that industrial age, 1950s, 1960s thing that our whole economy and retirement system is built off of, like, doesn't exist anymore?
Yeah, and so the story that I tell all the time is my dad's father. So my grandfather was married, lower middle class. He was a plumber, raised 3 kids, owned a house, owned a car. His wife didn't work, put the kids through school, all on one salary. And so that's lower middle class. So, let's say back in that day, it was, the equivalent of $30,000 or $35,000 a year of today's money. Today, it's not that uncommon for each of, someone working lower middle class, or it's the 50% of wage earners in America that make $31,000 or less, right? And that's, you're working at grocery stores and gas stations and Walmarts and Amazon fulfillments. And that's 50% of the workers. That's not household, that's individual income. So what's happened over time is that expenses have been going through the roof, and the cost of food and energy and inflation is gaining a lot of momentum, and salaries aren't keeping up with it. It's really that simple. So now if mom and dad each have 2 jobs here in 2020 and their households making bringing in $60,000 or $70,000, like they're not putting the kids through school, and they don't own their house, they're renting, they're living paycheck to paycheck. And I think that's happening for a lot of Americans out there today. And the problem is that the just expenses are just skyrocketing, and salaries aren't keeping up with it. So I don't know what happens in 50 or 100 years. I don't know if it's, everyone has 3 jobs at some point. I don't know if universal income gets kicked in and that offsets a little bit of it, but it's not heading in a good direction. And things are just getting more expensive, and we're seeing, total industries getting wiped out through COVID, whether it's, the sports industry or entertainment or promoting concerts, or, if you were an owner and operator of office buildings, like that's out the window right now. So a lot of these jobs have been going away. I think the total, 55 million jobless claims through at some point which is just a massive number. And obviously some of those people are going back to work now. But I think the biggest risk, and this is something that most of us have been taught growing up, is that you want to go and you want to work somewhere and you want to get some sort of, tenure at that place. And that's the less risky thing. And I think right now that's the most risky thing. I think you actually need several streams of income to be safe. And it doesn't mean you need to go start some big companies, but putting all your eggs in one basket in corporate America, I think that's risky as heck. And just personally, I think, it's being diversified with different investments, focusing on passive income, whatever your day job is, and have some side hustles and create different streams of income.
Yeah, absolutely. I think that is the key, is the multiple streams of incomes. My mentors, they wrote a book, The Honeybee, that, is like a parable that completely outlines that story. And even for me, like, I work for the government, and that's like, if you're not as close to the faucet as that, like, I don't know what is, right. And in the last couple of years, I started hearing things like, what the hell is sequestration? Like, what do you mean I'm going to lose my job? I work for the government. Like, that's not a thing. Like, furloughs and rollbacks and all these things like that are creeping into conversations where I work, that usually it's like, if you get in, you're in, you do your 20 years and you get a pension. And people are realizing like that's not even secure anymore. So I think multiple streams of income and cash flowing assets, pretty much the most recession-proof thing you can do these days, at least that's Vince Gething's opinion here. So with that said, where we're at now.
And the education part of it's huge, right? I mean, that's what you guys are doing, what you're doing. And we all have personal development backgrounds, but there are some people that aren't happy with how their life is going, and they don't choose to try to make it better. They choose to just turn on the TV for 5 hours a night. And, the hardest things to do is start businesses and investing in things that are kind of outside of the norm. But there's some level of calculated risk there, but I think it really starts with education.
Yeah, absolutely. And like you said before, like same path, like I went on Amazon and I was getting a box every week of just books, like 3-4 books a week. I was at a point where I was reading like, 50 books a year, 60 books a year, just consuming everything and everything. I went through the whole Rich Dad Advisor series with the Ken McElroys and stuff like that. And all of those, pretty much everything to do with real estate, everything to do with personal finance and those type of strategies, and just that self-education, never being satisfied on that front. I'm just always seeking to educate more. There's always more to learn. There's always somebody smarter than you. Find them, maybe create a podcast so you can get them on the show and ask them questions. We do all those things, right? That's what we do. So awesome point there. And so for 2020, right now we're in December 2020, been in the COVID thing for a while. What is on your horizon for 2021? What are you forecasting for mobile home parks, things like that, or whatever else other investments you're looking at? Because I know for apartments, like as you said, that search for yield is getting strong. We're seeing tons of capital flood into the apartment space, and for the last year, really compressing cap rates when nothing in the fundamentals of the market would justify the cap rates we're seeing, the valuations we're seeing, but they just keep getting compressed. And one of the big factors for that is, we have the low interest rates and things like that, but it's just that search for yield. And then small groups like us, 4 or 5 people firms, the mid-sized ones like you, 75, and then like those institutional investors that are just coming down with the hammer and a big checkbook, that are just overpaying, finding cash flowing assets harder and harder. So we're seeing that in our space. And how are you seeing that? What kind of interpretation of the data are you doing, and what's on your horizon for 2021?
Yeah, I mean, we're seeing probably more so this year than ever before, more institutional money and heavy cap rate compression. I mean, we saw stuff trade. I want to say here it was in Phoenix, a stabilized mobile home park portfolio traded 3.5 cap, ended up selling 4. So 4s and 5s are pretty common now. 6 years ago, we could find stuff at 10 and 12 caps, maybe even more. So we've seen a lot of compression in general, at least when I'm talking to brokers and other people in this asset class. Everyone pretty much thinks that the trend's going to continue next year, where it's going to, we'll see some more cap rate compression. And what's interesting at the same time, and Ken McElroy talks about this quite a bit, is that there's millions of residential mortgages that are 90 days delinquent right now. So the banks are in the process of taking those back. There's all the office space, retail, restaurants, anyone who hasn't been paying their bills or their business has gone under in 2020. The banks are now taking back those assets. And at some point next year, maybe the next few years, those are going to start to hit the market. So on the single family side, you've got, like you had mentioned, just across the board, record low interest rates. You've got very low housing inventory in general. So here in Phoenix, where we're based, if you've got anything that's under a jumbo size loan, you have a house for $350,000, which buys you a nice little house here. You've got 15 or 20 offers on it. You're above asking price. Just stuff's moving so fast. So at some point, there's going to be this glut of inventory that hits the market next year. And maybe that just affects residential and, the stick-built single family and kind of compresses some of that equity down. I don't know if that would cause a correction or not. I mean, Ken McElroy thinks there's going to be a crash next year, a real estate crash. And even if that happens, I don't know if that's going to really impact our asset class. And really until the demand for affordable housing changes, which through COVID, I think it's only going to increase. Then our asset class is pretty sheltered through a lot of stuff. And like everyone else, when the lenders stop lending through things like this, that impacts us, and private equity stops for a while. But those are usually all temporary. And I think rates are going to be low for a little while longer, at least another year or two, according to the Fed. So it'll be really interesting. Then of course you have the stock market, which is very, very, very strong. And I don't know what it's propped up on. I mean, it seems kind of like magic to me, but they keep, the government keeps pumping money and printing money into the market, and the stock market's at an all-time high. So, I mean, it isn't sustainable. So something's got to give at some point. And maybe it's some of the residential and some of the commercial, like office space, that starts to, maybe there's sectors that kind of have a correction next year, but I don't see it impacting our space at all, negatively at least.
Yeah, and I agree as well. Right when we're talking about this, this conversation usually leads to, okay, when the shit hits the fan, so to speak, it's like you get one group that got the flight to quality, right? So they go buy nicer assets. That's where you see like the core plus people. They go into the nicer assets, and then there's the group that goes to the more cash flowing assets, like the value adds or the mobile home parks that are going to cash flow more. I'm in the latter because my thing, if I'm a person, I have a family. Like if I need something happens to my situation financially, personally, I'm going to downgrade my expenses as much as possible, right? If I lose my house, and then if I'm one of the ones that millions of people that forbearance is coming due and I can't pay, and I have to short sale or whatever, lose my house, I'm going to have to rent for a while. I'm going to have to downgrade my lifestyle to get through this storm. So that seems a lot more logical to me, which why, like for us, we do a lot of value add apartments, so that the CC plus stuff and the mobile home parks, like the cash flow as well. And people are, to me, when people's financials are impacted, they're going to have to downgrade their lifestyle and move into something like that, even if it's just temporary for them. Everybody still needs a place to live, So I think that's to me, that's my mindset when it comes to that split in conversation that we see of like, okay, what does 2021 look like? Are we going to get more quality assets, flight to safety, or flight to quality, or more cash flowing assets? And I'm firmly in the cash flow bucket.
Yeah. Another thing which is interesting is that, you look at what businesses or industries have done well through COVID. The home furnishing companies, the Home Depots, anything that's DIY, right? People are installing stuff in their homes because they're spending so much more time in homes. Those aren't moving. You've got moving companies that have had a busy year. You've got a lot of brokers and agents on the residential side that have been really busy. Of course, companies like Zoom and some of the tech companies that just kind of caught this, but that's another interesting thing. I mean, grocery stores knocked it out of the park this year for the most part. So, and that's not, you can look at some of these buckets as energy and food, but I mean, restaurants are getting their butts handed to them, but grocery stores are doing, have done really well. So it's always just interesting to go back and look at some of that data when it starts to become clear. And that's other things to potentially invest in as well, as things that are going to, I mean, because again, we're not in a recession. We're in this gray area of this pandemic, but there's some industries that kind of knocked it out of the park. And of course, there's some things that are being created right now that we don't even know, like the Ubers and the Airbnbs that all came from the subprime crash, right? So there's new problems now that weren't there months ago that people are trying to solve. And there'll be some companies that get created from that.
Absolutely. And when you're talking about the data, like whenever the dust settles and all the data, kind of falls out where it is, it's going to be really hard to do like broad strokes, because the governors of each state had such an influence on the outcome of this state. Like we have, like you said, you're in 16 markets. We have properties in Michigan and we have properties in Texas, almost identical asset class, almost identical tenant base, completely different outcomes on how they've been performing over the last 9 months. The Michigan property has been much more difficult to maintain over the last 9 months, where you have to be a lot more flexible, keep pivoting with every time, the governor gets on the news. Where in Texas, it's been, we were having a banner year for the company in Texas, just absolutely crushing it. Leasing units up at market market rents before the paint even dries. Like, it's been incredible there. So the data is going to be, I'm like to see like the guys like Neil Bow and stuff like that, like, the super, data people that really analyze this stuff, to see like almost like each state has to have like their own, way of how they handled it. I don't think there's going to be like huge broad strokes that are very valid, just because each state seems to be so different. Very interesting stuff.
No question.
All right, Steve, that's it for me.
Yeah, no, this is great stuff. Yeah, it's almost one of those things, right? We're at a certain point, I think it will be super interesting to kind of do an autopsy, I think, on what, once we get a few years down the road here and we kind of see how all this stuff shakes out, what kind of, to your point, Andrew, like what kind of new businesses are going to be formed. And that's part of the entrepreneurial mindset, right? Like, hey, we're solving problems. Some great stuff is going to come from this. So, but I feel like that leads into my first question in regards to the fire round. A big part of, and you touched on it earlier, the education piece, right? People have to have kind of this mindset of, hey, look, I can be a problem solver. I don't just have to do what my government or my, state, local, federal is trying to tell me. I don't have to be put, pigeonholed in this little box. I'm a problem solver, right? I can be creative. I can come up with a solution to the problems that I'm facing. But in order to do that, my own personal experience was through just how Vince was talking about earlier, man, you've got to overcome a lot of that kind of mental shackles. You've got to understand, hey, there's people that have been down this road before. Re-educate yourself, understand that it is possible. So my first question on our fire round is, what's the best book that you recommend other than Rich Dad Poor Dad? I know you mentioned you cram through them. So, what's the best recommendation? You can give a few too. Sounds like you've probably got some good ones.
Yeah, and it's hard because I think in general, like I'm rereading right now The Compound Effect that Darren Hardy wrote, who really, really great, motivating, and I'm drawing a blank on the broker, the big Gary Keller. If you guys read that, The One Thing, right?
One Thing.
So some things are like The One Thing is great for big picture, and Compound Effect is great for time management. I listened to all the Brian Tracy and the Zig Ziglar and all of that stuff, and actually ended up becoming good friends with Kyle Wilson, who was Jim Rohn's business partner for 20 years. Kyle's actually in Dallas. So got, kind of around all that stuff, got to meet Darren Hardy and spend time with Brian Tracy and some of those guys. The guy who wrote Perry Marshall wrote the 80-20 of, let me make sure I have the name right, but it's unbelievable book for marketing. It's called the 80-20 of Sales and Marketing by Perry Marshall. So it's almost like you have to drill down to different categories, right? Because you've got kind of the personal development in different buckets there, and then you've got mindset stuff, and but those are great. I would say The One Thing, Compound Effect by Darren Hardy, One Thing by Gary Keller, and then 80-20 of Sales and Marketing.
Give us a real estate one. What's a real estate one?
Man, I mean, huge fan of Ken's books, Ken McElroy. So
I don't think there's any mobile home books out there that I know of. I guess I've never even looked on Amazon or anything, but maybe you can write that.
Yeah, I don't know if there is. It's a really good question.
Definitive guide to mobile home investing.
Right.
There you go.
Yeah, Ken's got a book called The Sleeping Giant, which is just all about the entrepreneur path. And any of his books on, the ABCs of property management or real estate investing, those are just great. Solid books.
They're great because they're really dense. They're like 100 pages, 120 pages. Like they're not that big, but it's like every page is like dense material, not a whole lot of fluff. And that's what I really liked about those.
Not much fluff.
Or two, and it's just awesome content.
All right. Yeah. Great recommendations there. So you guys, we'll make sure to put those in the show notes. So you guys can check them out. So what would you consider as your superpower, Andrew?
My superpower, I would say it might be a strange one, but I think I have a pretty high level of empathy. So I can read people really well in a lot of situations, which is kind of a double-edged sword sometimes. But I think that's probably my superpower is empathy, man.
Hey, I resonate with that one. So I appreciate that.
Yeah.
Okay, right on. What's the biggest lesson that you say you've learned over your career so far?
It was really hard to go from being in corporate America and having a pretty, all jobs in corporate America can be bad, right? You can love what you're doing or embrace corporate America and that culture, or you're someone like myself that was really built to be an entrepreneur, but I did that gig for a while, and it was great lessons and great gig. But that transition from going from corporate America to out on your own and building companies, I mean, that's terrifying across the board. And so I think what really helped was all of the personal development and getting around, people like Patrick Donahoe and Ken McElroy and Kiyosaki and anyone who's kind of been in personal development and built businesses. And whether you're hearing them speak or reading their books or having conversations, that was just huge, really. There's so much time in the day that you can be spending listening to podcasts and things that don't cost very much money. I mean, books, for example, they're not free, but man, there's so much you can get out of it. So that was a huge, it's like you're building this bridge from corporate America to your own thing. And in your mind, the bridge is going to be done one day and you're just going to walk across it. But in reality, it's like, it's not going to be done and you're going to have to jump at some point. And that jump is pretty terrifying, but also pretty worth it. And you kind of look back at some good lessons.
That's great. I actually love what you just mentioned.
I got a good quote on that. This quote, whenever people talk about all the free education, we've been pounding it away at this on this podcast, but there's a quote from like Goodwill Hunting. It's like, you wasted $150,000 on education when you could have got it for $150 or $1.50 in late fees at the public library. And I think that's very true. People make a bunch of excuses. Oh, books are expensive, or courses are expensive. Like, libraries are pretty powerful. You can go request pretty much anybody. If it's got a ISBN number, go to your library, get a library card, and just start requesting all these books. And they'll find them. It might take a while because they have to ship them in from another library. But the U.S. library system is pretty powerful that people often forget about because of how easy Amazon is. But
yeah, and you could just spend forever on YouTube or podcasts, right, without even cracking a book and have a lot of information on that for free too. So
I love your quote right there, even just saying there's so much time in the day. I think too often we get bent going the other way. We say, oh, I don't have enough time in the day. And it's like, I'm a huge believer in words have power, and that's creating your reality. So yeah, if your mindset is always like, you know what, there isn't enough time in the day. I don't have enough time. Like, to me, you're speaking that over yourself. So I love that, even just that small bit of like, no, there's a lot of time in my day, and I'm choosing to actually do some productive things with it. So that's awesome.
We all have 24 hours, right? And some use it very differently than others, but we all have the same time.
Yeah, no, that's great. Kind of leading up to the last question, what's for the busy working professional, is working towards financial freedom? What advice do you have for them?
Yeah, I think it's just everything that we've been talking about. It's education, it's personal development. I mean, the personal development part's probably one of the most important pieces of it, because if you're someone who's working and you're busy and you're working a busy job and you have a family and all the other things that most people have and take up time, you've got to decide, do I want to be in more of a passive role making investments, or do I want to be more active? Do I want to be like you guys, like actually going to buy the apartment and raising the money and doing all of those things as an operator or sponsor? Do you want to be more on the passive side? And I think through personal development, you can really learn about what's really important in your life. And if you're looking for more work and more jobs, or looking for just something that's a little bit easier, and there's always a combination of both. And there's always people that start out being very active, and that's how they kind of learn. And eventually they're going to end up in more of a passive role. So honestly, it's everything we've been saying. It's education, it's personal development. And especially if you're not really sure which path that you should be on, then you kind of immerse yourself in that. And, 12 months later, you're going to come out the other side with a lot more direction, or at least start eliminating things on the board, right? Well, I'm definitely not interested in that anymore because I learned a whole bunch about that, or met someone who was doing it. And, it's almost like process of elimination. So I think it's just going deep and figuring out what you want.
Oh, that's great. That's great. Well, as we kind of wrap up here, how can our audience get in touch with you? How can they learn a little bit more about you?
Yeah, so the company site is fourpeakspartners.com. We've got some information, mostly educational content, and we do a lot of writing and blogs and stuff. And then I have a podcast out called The Impatient Investor, and that's theimpatientinvestor.com. And it's kind of a short solo podcast, very topical, and it's everything. We're just really big into private investing, private equity. Anything that's outside of Wall Street has been something that we've been a big cheerleader for. So it's really all things outside of Wall Street.
Yeah, definitely. He's got a great podcast, guys. So make sure that you check it out. We'll make sure we link down to below in the show notes there for that one as well. Well, Andrew, any parting thoughts or anything as we kind of wrap this up?
No, just appreciate what you guys do. There's a reason why I think all of the personal development and this amazing content is I feel like we've kind of gotten to a tipping point because we're all, trying to row in the same direction. So it's awesome what you guys are doing, and keep up the great work.
Much appreciated. You as well.
Thanks so much, Andrew. Thanks for coming on the show with us. Really appreciate it.
Okay. Thanks, guys. Appreciate it.
Aloha. Thank you.
AC, that was an awesome show having Andrew on. Took a bunch of good notes on there. Some of the biggest ones, obviously he started single family in the recession of 2008, 2009. Sounds like he did very well on that portfolio. Talk about exiting some of those, taking some of that capital, repositioning it into his choice asset, which is I think the first on our show, or maybe the second on our show that is doing mobile home parks. So 2,500 mobile home parks. Or mobile homes, which is a very good asset, very well cash flowing, and is becoming a lot more popular. It used to be kind of like this fringe asset, 10, 20 years ago. And now people are seeing a lot of value in that market. Like we said, we talked pretty in depth about investors continuing the search for yield, making sure that, they're trying to park their money in good assets that are giving them the yield, because everything that's going on in the market, it's getting harder and harder to find. So awesome that he found that ideal investment. And to him, that was his version of a recession-proof investment, was those mobile home parks, right? Where's a huge chunk of his portfolio. Also like that, or both of us were pretty bullish going into 2021. We still think our models are affordable housing is still going to remain strong. A lot of people are pivoting right now, like I mentioned in the show, and trying to forecast what they think is going to happen. Me and Andrew, or us and Andrew, we're still in the same, we're staying the course that, affordable housing is still going to be a force, and there's still going to be a shortage of it. And it's not going to be solved next year. It's probably not going to be solved in the next 5 years. So we think it's a great asset class. And we're in affordable housing apartments. He's in affordable housing mobile homes, very similar models and the numbers wise. So that is very awesome to see that we're not the only ones. We're staying the course. Many investors are staying the course of affordable housing. That it's good, and it will continue to provide us and our investors good return. So that was what I took away. Obviously, personal development stuff. So big personal development, big mindset. I took down a couple of books that I'm going to go order, especially The Sleeping Giant. I read all of Ken's other books, like the ABC books, those Rich Dad Advisor books. I did not read The Sleeping Giant. So that is one I'm going to go order. I'm going to check out that 80-20 principle as well of sales and marketing. And then I also really like the idea of his personal legacy, like vlog thing that he has. His format of his podcast is those 5-10 minutes, I think that's awesome. So definitely go over there, check his podcast out. Seems like a very, very valuable, unique offering out in the world of podcasts that we have. So definitely check that out. But that is all I have, Steve. Off to you.
Yeah, no, absolutely. Yeah, great having Andrew on. So if you're interested in connecting with us, go to tricityequity.com to learn more. To connect with other like-minded investors, join our Facebook group, Honolulu Multifamily, and more. If you found value in this podcast, please subscribe and give us a review on Apple Podcasts or Spotify. If you know anyone who might resonate with today's podcast, please share the episode with them. See you next time.